Hi, Joe Kehrig with the Kehrig Real Estate Team, and this is your San Ramon Valley update. And the big news this week, the Fed has spoken. In meeting this September, they actually lowered the discount rate 0.5%. We haven't seen that in years. It's been going up and up and up, and they've been threatening going down a quarter here. Well, just so you know, we were anticipating maybe lowering it 0.25%. And the interest rates now are at their lowest point and they've been in over a year. They went from probably 7.5%. You can actually get a loan, a 30-year fix, for under 6% now in the high fives. So what is this going to mean with the discount rate lowered 0.5%? Well, first off, understand the discount rate doesn't have anything to do with mortgage rates directly, but on the ripple effect that they do, and they do affect the market. Now, if they would have lowered them 0.25% because everyone was anticipating that, the rates would have stayed the same because it was already baked in this latest reduction that brought us down below 6%. But the fact that they lowered it not just 0.25%, but 0.5%, expect to see rates go down a little bit more. Maybe we'll start seeing, someplace like 5.5%, and here's big news. They're talking about maybe coming back again this year and doing at least another 0.5%, maybe even a little bit more. We might even see some adjustable rates and some jumbos actually drop into the high fours by the end of this year. Why is all of this happening? Well, here's the bottom line is if you're a buyer or a seller. When the economy is not doing very good, interest rates drop. Because what they've been doing when the economy was going nuts and unemployment was low, the Fed kept raising and raising and raising and raising. Well, now that basically the economy has slowed, the inflation is down near 2%, unemployment rate is actually going up. Now what they do to spur the economy when we're going into a recession, they lower the rates. How does that affect the real estate market now going from 7.5 to 6.5 to 6 and maybe even 5.5? Well, here's what happens. The last 30 years, when rates go down, first off, rates go down when the economy isn't doing well. Well, how does that affect the real estate market? Well, I tell you, in 6 of the last 7 recessions, the real estate market has, one year, 1991, it actually stayed about the same. But the other 5 out of 6 years, prices went up during the recession. It was only the Great Recession of 2007-8 that basically prices went down as we were into that recession because the real estate drove us into that recession. So what you're going to see if you're a buyer, look at it this way. Interest rates are lower, but here's what's happened over the last 30 years. As interest rates have dropped, prices go up every time the last 30 years. So it all ties together. The economy starts to go down. We look like we're going into a recession. Interest rates go down, prices go up. Why do prices go up on homes? Is because as interest rates go down, we already have a supply and demand problem, but as interest rates go down, you see more buyers coming into the marketplace. Because right now, there's a ton of people out there that are at 3 to 4% interest rate. Now, when interest rates was 7 or 8, they weren't going to give up their 3 to 4% interest rate and move. But most experts feel that the delta is about 2 percentage points. So if you have a 4% interest rate and you can get now below 6%, within 2%, most buyers are comfortable making that move if they were wanting to make the move but just holding back. So you're going to see a few more homes come on the market, but you're going to see a lot more buyers flood the market, which obviously is going to eat up the supply out there, which is a little bit low right now. And so you're going to see prices go up because no matter what anything else tells you, it's all about supply and demand. Low interest rates, high interest rates, they all drive the supply out there. It all comes to the coordination between the supply and demand. So what's going to happen, not as many listings out there, more buyers out there, and less inventory, which means prices are going to go up. How is that affecting our local market? Right now, it hasn't affected it really at all because this just happened in the last couple of days. But anticipate that more buyers are going to go out there. Like I mentioned before, if you're a buyer, you want to go out there. Now, some buyers might be sitting there and going, well, I'm going to wait because interest rates, if they're like 6% now, they might go down to 5%, so I'm going to wait. Big mistake. And this is why it's a mistake. If interest rates go from 6 to 5, yeah, you're going to get 1% less, but you're going to pay higher for a home. The better strategy is to go out there and look now while there's still some inventory, find that perfect home. Yeah, if you have to pay 5 3/4, 6%, go ahead and do it. Then next year, if they do drop to 5%, 4.75, then just refinance at that point. So if you're a buyer, I would definitely be out there looking. If you're a seller, I would also be out there looking to put the home on the market if that's your plan, because you have a situation where towards this time of the year, the fall, you have less inventory, and now you're going to have more buyers. So again, it's a great time to be a seller out there because not a lot of inventory and more buyers hitting the market. So it's actually one of those time periods where it's good to be a buyer or a seller. So take a hard look at it. And obviously, always give us a call if you want to sit down and do some planning. But let's look at our local market. Look at the San Ramon market. You can see that inventory stayed about the same. Pendings have stayed about the same. Remember, at one point, there were more pendings than active properties. But obviously, since July, you'll see less and less inventory. And with the higher interest rates, there hasn't been much activity. You're going to see this change. You're going to see less inventory and more pendings. You just watch the next couple weeks. The Danville market, you can see, with all the other markets, you can see the inventory has gone up a little bit and pendings have gone down. Now, part of that is the time of the year. August, traditionally, is always the slowest month of the year because people are getting their vacations in, they're getting ready for school. So after Labor Day is when the market normally picks up. So anticipate, especially with the lower interest rates, the market picking up. But you can see that the inventory is up a little bit, pendings are down. Same thing with Alamo, about the same on the actives. Pendings are down. Dublin market, actives up, pendings down, just like we talked about. But here's the thing that you're looking at when you look at these numbers is, remember when the market was going nuts, we were talking about 110 to 120% of asking homes we're getting. And then for the most part, it's been between 100 and 105%. Now we're seeing mostly in the 90 percentile, and that's not even a true number because I would say it's at least 5 percentage points less than that because we're still seeing a lot of price reductions. So if we basically went against what a home was originally priced at comparatively what it sold for, these numbers would probably be in the low 90s instead of the high 90s. So again, you know, every market's a little bit different. You know, if you're thinking about making a move or if you're thinking about purchasing, we can get you together with some great loan professionals that we work with personally, and they can kind of guide you through it. You can look at the numbers because remember, putting your home on the market and purchasing another home, getting your home on the market is actually the fourth step. The first step is to meet with us to get an idea, okay, what would my home sell for? Second step is to then meet with a loan professional, say, okay, if I sold it for this, I had this much money, what does that mean as far as my purchasing power? Third step is actually go out there and say, okay, well, now this is a price range that between what I'm selling for and what the loan officer tells us we can get for as far as interest rates. Then we go out there and look, it's a third step, and you might decide, hey, it still doesn't make sense. Or if you say, hey, this really looks good, then the fourth step is to put your home on the market. So there's a lot of planning that we can walk you through. And if you're a buyer, it's the same type of thing. Really, what are you looking for? And we can help guide you because every market's a little bit different. Give us a call, Joe Kehrig at the Kehrig Real Estate Team, cell number 925-487-6838, or drop me an email, joe@kehrigteam.com. Or if you want to learn more about the Kehrig Team, visit our website, www.kehrigteam.com. This market's going to be very fluid in the next month. And remember, elections are coming up. As we've talked about in previous, videos, the election really doesn't, for a couple weeks it affects because everyone kind of stops when they're uncertain. And one thing we know for sure, 50% of the country is going to think that it's going to the pits after the day after the election. But after a month, we get into January, 9 out of the last 11 elections, prices have gone up, interest rates have gone down after the election. So be out there, whether you're a buyer or seller, give us a call. Stay tuned. Lots going to happen in the next couple of weeks. Have a great week.